Welcome to the latest edition of the Knowledge Shop Tax Roundup. In this month, we're going to be looking at the latest update from the ATO on the Bendel case. Lots of questions that people kind of not sure what the answers are at the moment in terms of practically how do we respond to what's happened in the Bendel case to date. We're going to be looking at that later on. But first, Amy's going to give us a bit of an update on what's been going on in Parliament just before the federal election was called. Now, in the last edition of the Tax Roundup, we gave you a very brief update in terms of some of the key legislative changes that made it through Parliament before the election was called. But this month we thought it would be a good idea just to take the chance to expand on some of the key elements of tax-related legislative change that's gone through Parliament. So first of all, the instant asset write-off. The $20,000 instant asset write-off threshold has been extended to cover the 2025 income year. But Amy, what are some of the key things that businesses need to be aware of, and what do they need to do to make sure that they're locking in the benefit of any kind of large upfront deductions in the 2025 income year?
As part of the 2025 budget, the government has extended the $20,000 instant asset write-off until 30th June 2025. So this change was part of the Treasury Laws Amendment Tax Incentives and Integrity Bill 2025, which was passed through Parliament just before the election was called and is now law. Now, what does this mean for businesses? For small businesses with an aggregated turnover of less than $10 million, they can instantly deduct the full cost of eligible depreciating assets costing less than $20,000, provided the assets are first used or installed ready for use between 1st of July 2024 and 30th June 2025. If a business claimed an immediate deduction for an asset under the simplified depreciation rules in a prior year, they can also claim any second element costs incurred after that income year, as long as they are less than $20,000. So how does this work? The $20,000 limit applies per asset, which means that businesses can instantly write off multiple assets. If an asset costs $20,000 or more, it can still be placed into the Small Business Simplified Depreciation pool and depreciated at 15% in the first income year and 30% in subsequent years. Also, any pool balances under $20,000 at the end of the income year can be written off. So who is eligible? The asset must first used or installed ready for use between 1st of July 2024 and 30th June 2025. And the business must have an aggregated turnover of less than $10 million. And to claim this, the business must use the simplified depreciation rules. If they do, assets that cost the same as or more than the relevant limit would need to be placed into the small business pool. Now, there are a few things to keep in mind about these rules. So there is a car limit for passenger vehicles. If the vehicle isn't classified as a passenger vehicle, now the limit does not apply and the business can still claim the full cost as long as it's under the relevant limit. And there are also certain assets ineligible for the simplified depreciation rules, including the capital works, buildings, structural improvements, assets leased out for more than 50% of the time, as well as low value assets allocated to a pool before using the simplified rules. Also, software development pool assets, but not all softwares are excluded from the write-off rules. Assets used for R&D activities. And now we're looking at how GST actually impacts the deduction. So if a business is registered for GST and can claim the full GST credit, then the GST amount paid on the asset does not count when calculating the depreciation. But if the business can only claim a portion of the GST, then the cost of the asset will be reduced by that portion. So if the business isn't registered for GST, you include the full GST amount in the depreciation calculation. So how do we work out the deduction? Now, the entire cost of the asset must be less than the relevant limit, excluding any trading amounts. Whether the limit is GST inclusive or exclusive, it would depend on whether the business is registered for GST. To work out the deduction amount, you will need to subtract any private use portion. The portion used for earning assessable income is the taxable purpose portion, which is the business purpose portion. While the deduction can only be claimed on the taxable version, the entire cost of the asset must be under the relevant limit.
Amy, from 1 July 2025, we're aware that taxpayers won't be able to claim a specific deduction for general interest charge or shortfall interest charge anymore. Can you explain when these charges are incurred and how that will impact on taxpayers' ability to claim deductions for these interest charges in future?
Starting from 1st of July 2025, taxpayers will no longer be able to claim deductions for GIC and SIC charges. Now, what's changing? The two main interest charges we're looking at are GIC, which is the general interest charge. So this is the interest that ATO charges when you have an outstanding tax liability. It's calculated on a daily basis and can accumulate pretty quickly. SIC, which is the shortfall interest charge. So this charge is imposed when there is an underpayment of tax. So typically after the ATO issues an amended assessment. So until now, taxpayers could claim deductions for both SIC and GIC. However, now with the new law, any GIC or SIC incurred after 1st of July 2025 will no longer be deductible, regardless of whether the underlying tax liability relates to periods before or after this date. And it's important to note that any SIC or GIC incurred before 1st of July 2025 is not affected by the change. So these charges will still be deductible for the 2024 to 25 income year and earlier periods. So if you've already incurred these charges before the cutoff, there is no impact for those earlier years. So in terms of the timing of deductions, the new rules will apply to GIC and SIC incurred from 1st of July 2025 onwards. However, if the interest was incurred before the date, you will still be deductible, even if the relevant tax return is lodged or the payment is made after the law change. So now, in terms of what it means to be incurred, the ATO has clarified that it's incurred for tax purposes in the year the taxpayer is notified of the liability. So even though the interest accrues over time, the deduction is typically claimed in the year the ATO issues the assessment. So for example, if the ATO informs a taxpayer in 2024 about a tax liability and the interest continues to accrue into 2025, the GIC will still be deductible in 2024, even if it's paid in 2025. The key is the timing of when the interest charge is assessed. So what happens if GIC or SIC is remitted? If the ATO decides to remit any GIC or SIC is generally treated as a recoupment. This means that the amount remitted becomes assessable income in the year that it's remitted. So if a taxpayer has already claimed a deduction for the interest charge under Section 25(5), the remitted amount will still be included in assessable income under Section 2020. But you need to remember that if the GIC or SIC was incurred after 1st of July 2025 and it's later remitted, it will not be included in assessable income. This is because the taxpayer wouldn't have been able to claim the deduction for those charges in the first place due to the new rules. So it seems like the remission of those post 1st of July 2025 charges will not trigger any assessable income.
Thanks, Amy. Certainly some things that we really need to be on top of as 30 June gets closer, but also into the new financial year as well. Now, let's turn our attention to the Bendel case. This is something that we've talked about a bit over the last few months. It's certainly been big news in the tax world, where the full federal court decision has really kind of upended the ATO's position in this area that has been long-standing. It's been there for a while now. But what we know is that the ATO has appealed this decision or is seeking to appeal this decision to the High Court. In the meantime, while we're waiting for the High Court to decide what's going on, the ATO has released some updated website guidance that deals with some common questions that have been coming through in response to that full federal court decision. We do know that the ATO a little while ago released an updated decision impact statement, which kind of went through what the ATO is going to do while we're waiting for that Bendel decision basically to be kind of finalised at the High Court level. But the ATO has now addressed some more practical issues. And so thought it might be time just to kind of make sure we're aware of kind of where the ATO sits on some of these practical issues before we then revisit some of the technical things that we just want to be considering, particularly over the coming months. The first thing is around timing. How long is this going to take to play out? Well, the ATO has indicated that, look, they don't want to preempt kind of how long it's going to take the High Court to decide. But at this stage, what has happened is that the ATO has sought leave to appeal the decision to the High Court. The High Court might decide not to hear that appeal. That's certainly a possibility here. That process could take a few months. So even deciding whether the High Court will actually hear the ATO's appeal, that first step could take a few months. And look, we'll obviously wait and see. The ATO says that if the High Court decides not to hear that appeal, then it seems like the ATO will have something ready to go almost immediately once that decision is handed down. The ATO said it will update its decision impact statement and will issue some almost immediate guidance in terms of kind of the resolution of this issue. However, if the High Court decides to hear the ATO's appeal, well, it's going to take longer. It's going to take some time for the ATO to kind of hear the appeal, to deliberate and reach a decision, and then hand down that decision. And that could take a fair bit longer. Now, while that all plays out, basically the ATO has been asked, well, is it okay for groups that are affected by this decision or likely to be affected by this decision to basically obtain lodgement extensions particularly for the 2024 year and possibly 25 year as well, depending on how long this takes? The ATO's response to that is basically they will not be issuing blanket extensions. The ATO says that, look, it's not policy to issue blanket extensions just because a matter happens to be proceeding through the courts. That's just not something that the ATO does. So from an extension point of view, this will continue to be on a case-by-case basis. I think the ATO's expectation is that whether you're impacted by this decision or not, that you continue to lodge your returns when they're due. If you want to seek an extension, you ask for it, but it will be case-by-case. One of the other things that the ATO is being asked is, well, what if as a group you decide to basically go with the full federal court's decision, which is the opposite of what the ATO has been saying to us for many years now? What if the ATO is then successful in the High Court and it turns out that some deemed dividends have been triggered under Division 7A? Would the ATO basically then issue a determination under Section 109RB, which allows the deemed dividend to be disregarded, or at least to be franked? And the ATO's response to that is somewhat predictable. The ATO says, don't necessarily expect that. That is certainly not a guaranteed position. It will again be on a case-by-case basis. So the ATO's guidance on that one probably isn't going to give anyone a great deal of comfort. If you decide to go with the full federal court decision and you basically kind of deal with the situation in accordance with that decision, even though the ATO has said that it will continue to apply its existing guidance to this area, look, you certainly wouldn't assume that the ATO will exercise that discretion if indeed the ATO is successful before the High Court and some deemed dividends end up being triggered. I wouldn't assume that the ATO will grant that discretion. My guess is that it might be less likely than not that the ATO would grant that discretion, but again, who knows? It's case by case, but the key message here is no blanket extensions in terms of lodgement deadlines just because this matter is being appealed to the High Court, and don't assume that the ATO will be lenient on you if you rely on the full federal court decision and that ends up being overturned by the High Court.
So, Michael, the ATO has been asked whether taxpayers should continue to convert UPEs to loans and place them under compliant Division 7A loan agreements whilst waiting for the ultimate outcome of the Bendel case. How has the ATO responded to this?
The other massive question that the ATO is being asked at the moment is basically for advice on should complying loan agreements being put in place for UPEs that maybe arose in the 24 year, maybe that start to arise in the 25 year as well? And should basically clients continue to apply the ATO's old guidance in this space while we're waiting for the High Court appeal anyway? And the ATO's answer to that is, again, probably not surprising. The ATO kind of shies away from giving specific advice on this. The ATO says, look, we've made our position clear. While we're waiting for the High Court decision, we're going to continue to administer Division 7A in line with our existing historical guidance in this space. And what the ATO is saying is basically that, look, if you want to take a more conservative approach, then you should consider basically converting UPEs into loans, certainly UPEs that are owed to corporate beneficiaries, and consider putting those under complying Division 7A loan agreements. So written agreements, think about your maximum loan term rules and your minimum interest rate rules as well. Basically what the ATO is saying is that, look, even if the ATO is not successful before the High Court, the ATO has made it clear that there are other integrity rules that can capture situations where income is appointed to a corporate beneficiary and it's not paid out within a reasonable period of time. The ATO, for example, refers to the reimbursement agreement rules in Section 100A and says that those could come into play even if that unpaid entitlement amount is not a straight Division 7A loan. What the ATO is saying in this latest website guidance is that if you take that more conservative approach of continuing to treat that UPE as if it is a loan for Division 7A purposes, like you would have in the past, and you put a complying Division 7A loan agreement in place, that should reduce the risk of other integrity rules being triggered as well, including Section 100A and also Subdivision EA of Division 7A, another aspect of Division 7A that can be triggered in situations where there are unpaid entitlements owed to corporate beneficiaries. The ATO is basically saying that, look, even if the ATO's position ends up being wrong on the key point that is being tested before the courts, there are other integrity rules that could potentially capture the situation where entitlements are owed to corporate beneficiaries and left unpaid, and that by treating those as loans and putting a Division 7A loan agreement in place, you are probably taking steps to minimise the risk of those other integrity rules applying. So whether the ATO is successful or not, by taking those steps, you are hopefully minimising the risk of triggering unfranked deemed dividends or triggering nasty tax outcomes under something like Section 100A. So the ATO is saying that it's up to each group to consider their own position, make their own judgment call on what they should do in this space. The ATO is not going to tell you exactly what you should be doing, but the ATO is giving a fairly unsubtle hint that if you basically use a Division 7A complying loan agreement, even if the ATO's appeal is unsuccessful, that will help you minimise risk in other areas.
And now that's the end of the April Roundup. At Knowledge Shop, we understand the challenges of staying ahead with ever-changing tax laws. And that's why our membership service is designed to simplify your practice. With access to up-to-date knowledge, a comprehensive suite of training programs, work papers, and our highly efficient help desk service, we are here to support you every step of the way. If you're not already a member, now it's the perfect time to reach out and discover the benefits of being a Knowledge Shop member. Thank you for tuning in, and we look forward to seeing you at the next Tax Roundup.